Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our second class on candlesticks, or the ABCs of Japanese candlesticks. Now, tonight's class is brought to you by ETX, and for those of you that are new to ETX, we are a regulated provider, so I'm required to give you a risk warning, so let me read that and get it out of the way. Trading in financial markets may result in a loss of the amount your deposited funds. Please ensure that you fully understand the risk or seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information is provided during this webinar for educational purposes only and is not intended to be a personal recommendation or construed as advice. All traders must understand that there is a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following a trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. Now, ETX is a regulated provider. We are a fast-growing services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority. And at present, binary options are not a regulated product, but will become regulated in January 2018. But because you're dealing with a regulated provider, you don't have to worry if you're using our binary option platform, because all your funds are in segregated accounts. We follow all the regulatory requirements for a regulated provider. We're also a member firm of the London Stock Exchange. Now, we offer many different trading solutions for if you want to trade with ETX. First of all, you can trade on the ETX binary options platform. It's a good way to enter the markets if you're not sure how to trade, or another way a good way to test your strategies. Because with a binary options trade, you're simply predicting whether the market will go up or down, and as long as your prediction is correct, you get the agreed upon profit before you make a trade. There's no leverage in binary options, and your risk is only the dollar amount you type in the screen. And you're simply predicting if an asset will go up or down. It's like a vanilla option. It's an all or nothing scenario. And then for those of you who want to be more advanced or want to trade in our CFD or Forex platforms, trade stocks or commodities, you have many choices. You can use our ETX Trader Pro platform, and that's our simple internet platform. You just log in and start trading, and you'll get the lowest possible spreads. You get all types of order entry systems, all types of stop losses, and you can fully customize the platform and the charts to fit your requirements. And for those of you who want to trade in the most advanced platform, you can download our ETX MT4 platform, where you can add on expert advisors. You can even use it to automate part of your trading system or your alerts and signals. But don't worry, at ETX, we have a solution that fits everyone. And we've just launched our newest ETX Pro platform, which now we have classes once a month on mastering the platform. And starting in January, we'll be doing most of our classes directly on the platform. So you'll be learning how to be an expert trader right on our platform. So go out, if you're not trading with our ETX Pro, or you haven't moved over to the new platform, just go on the button and click on the new platform, and you can always return to the old platform. It's up to you for the time being to trade whichever way you like. Now, tonight's class is being recorded. If you wish to see a recorded version of this class after tonight, give us about 24 hours, and then just use the same link used to come to tonight's class, and you'll be able to access a recorded version of tonight's class. Now, once again, our class tonight is the ABCs of Japanese Candlesticks, and this is part 2 of a 2-part series. Now, real fast, we're going to review what we talked about last week, and then move forward with how to use or incorporate Japanese Candlesticks into your trading system. If you missed last week's course, next week we're offering it, I believe, on Sunday. Just go to ETX, when you go to the ETX website, just click on education. You'll see the schedule there. But again, remember, candlesticks have been around since the 17th century. And each candlestick represents a data set for the complete price action during the time frame you selected. So in other words, if you're using a 15-minute chart, every bit of price movement happened in that 15 minutes is contained in that visual representation of a candle. If you're using a 1 hour time frame, that candle represents all the price action in that 1 hour. If you're using a 1 day, the same thing holds true. Now we have the body of the candle, which is the distance between the open and the close. And if you step up from the open to the close, in other words, the close is higher than the open, you would fill that candle in with what is considered the bullish color. Okay, in this case, in the most popular color systems today are red and green, but for many, many years before we had all of these computerized charts, it was a black and white system, so white was the bullish candle. But you can make the candles any color you like, because all the candlestick charts allow you to set what you want. So if you want to use orange and pink, as long as you know which one's bullish and which one's bearish, you're perfectly fine. But in most cases, it's black and white or green and red. Then we have what's known as the shadow or the wick. These are the high and the low of that time frame. And these are connected to the body. So what we see is what it looks like a candlestick with a wick above and below. Like I said, they're sometimes referred to as a shadow. Now, these wicks and candlesticks actually tell a very important story. They tell the story of who is controlling the market. And there are 6 basic different stories you can tell. Now, in this case, we're looking at a black and white chart. So the white is a bullish candle, the black is a bearish candle. So in these 6 stories, in number 1, it's a very easy explanation. The bulls controlled the market, or the buyers controlled the market from the open to the close. Now, at some point, the bears were able to push the price down for a second, but weren't able to hold, and the market closed near the top of the price, but not all the way up, because that's why we have an upper wick. In number 2, it's just the opposite. The bears were in control of the entire session and closed fairly close to the low, but weren't able to sustain the lowest point. At some point, the bulls had a little bit of a rally, but they couldn't hold on tight. Number 3, regardless whether it's the bears or bullish, it is the narrowness or the small body. When the body is very small, it means that the open and close were virtually the same. That's telling you there's indecisiveness. Nobody is in control of the markets at that time frame. Then we have 4, 5, and 6. They're very much, you see, the bodies remain small. But in one case, we have very long, low, very far down lows. That means at some point, the bears were able to really rally hard, but they exhausted themselves and weren't able to hold on to it. 5 is exactly the opposite. The bulls were able to muster up a rally, but they died out before the segment was over, and it ended up closing close to where it had opened. And number 6, we had a great big tug of war, but they made no headway in that session. So you can explain this or understand the story of what's going on in the market. Now, what you would expect is if the bulls were dominated the last time frame and they pushed up and closed near the high, you would expect the next session to continue on with that buying, and the bulls can continue buying up the markets. But if you end up getting a very small body, that's telling you either the bulls were bought out in that first session and they're either indecisive or they're gone. Okay, and so it's telling you that there's something going on in the marketplace. But don't let yourself get lost with the psychological response to the groups of greens and reds. Because if you notice, there's very little to do about how much red or how much green you see. And unfortunately, too many beginner traders let themselves get swayed. They see lots of red on a chart, but they don't realize that they have to interpret what those candles mean. And they just see lots of red and think, it's going down. They see lots of green, they think it's going up. But that's not what candlesticks are about. So we have to look at the candlestick itself to see if it's trying to tell us something, not the color. So, like for instance, here what we're looking at is one of the popular candles, and you don't have to remember all the names, but this is a Marubozu. What do you see in a Marubozu? Can somebody notice something in the diagram to the right? There are no wicks. So in the greenish Marubozu, tells you the bulls not only dominated the session, but they ran. They opened up and they ran and they closed at the highest point that they had ever achieved. That means that they were in, not just dominated, but they were in full control at the end of that session. The exact opposite is in a red. Now, when a Marubozu, and this is you need to write down and incorporate into your trading strategy, when a Marubozu appears in the opposite direction of a trend. In other words, if you get a green Marubozu in a downtrend, that's telling you that the downtrend is most likely over, and the opposite, in this case, the bulls have come back to dominate. If you see a red Marubozu in an uptrend, it's telling you the reverse. So it's very important when you're looking at candlesticks to always look at them where they come in to the session. Because even though they have definitions, it has to be within the trend pattern. Number one, you have to be able to execute or differentiate between a very weak trend, a sideways action, and a trend, a consolidation. When a Marubozu appears, even if you're in a consolidation, if it was a downtrend and it moved in consolidation, and then the Marubozu appears, it's telling you what? It's telling you the bulls have now come back into the session, and they're going to begin the uptrend. When the red Marubozu appears, it becomes the opposite in a downtrend. In an uptrend, and that uptrend is over, or the consolidation time is over because the traders decide what they're going to do, and it marks the beginning of a strong downtrend. Okay. We have things like spinning tops and dojis. Now, last week we talked about that. Dojis tell you there's a major tug of war going on and a big indecisiveness. Now, a doji is a very tiny body. In most cases, especially in stocks, it says that the open and the close have to be virtually the same. In Forex, because there's so much volatility in Forex and it's traded in such small increments, because you're trading in small pips, that it can be a different, there can be a set, a difference between an open and a close, but it must be very narrow. It must make a very, very small body on the candle. So that's where you see the difference between this one, that's telling you the open and close were exactly the same. And here you see that the open and close were slightly different. But what it's telling you is you have a lot of indecisiveness in the markets right now. So if you were in the market, you might be looking to get out and be very wary of it. If you were looking to enter the market, you might want to sit back and wait a second longer. And dojis appear with different ways. We have dojis with long bodies up or long bodies down. But we always have to look at where a doji or any of these appear in a trend. It's very important that you're aware of where they're appearing. So, in other words, when we see a downtrend and we see a doji forming, in this case we could see it that it had popped up to the resistance line of the trend line and then moved back into its downtrend. Again, here we see it appear as the price is trying to bounce back up to that resistance line, bounces off of it, and moves back down. So this is telling us that this little upward momentum was over. In this case, it's telling you again that little upward momentum was over. But you always have to look at it in relationship to where price is in the uptrend or downtrend. You can't just look at any of these signals and ignore the trend. It's more important to understand what is appearing. So we have all kinds of weird names, but you don't have to run. Dragonfly, Gravestone, we have the long-legged dojis. They tell you who controlled the market, but you don't have to remember the names. You just have to remember that it's a doji. Don't even have to remember it's a doji. What you have to do is it tells me that there's a lot of indecisiveness in the marketplace. So before turning to the single and multiple candlestick patterns, there's some general guidelines to cover. Okay. Now that you have the basic idea of and I'm sorry I'm rushing through this, but we did all this last week. So I'm trying to get through the primer from last week so we can get on to the new stuff for today. So now that you have the basic idea what candlesticks indicate with their bodies and wicks, let's cut some teeth on some simple, uncomplicated patterns. Now, they are fairly common and quite likely to appear for you in a normal trading session. So knowing instantly what they mean and taking the proper trading decision immediately could make the difference between a winning and a losing trade. Now, if you came to class last week, I gave you a handout that had the 16 most popular patterns and how to use them and how to calculate them. If you didn't come to last week's class, if you come to next week's class, class 1, you'll get those handouts again. Okay. But there's also it's not just the shape and the size of the candle, there's something called positioning. It's where that candle is in relationship to the previous candles. And we have shooting stars, we have inverted hammers, we have hanging men. Okay, and they look just like they're called. Okay. And again, if you get that handout, it'll go over it. I just don't have the time in tonight's class to go step by step. Now, Harami we'll stop on for a second because Harami is a very important pattern. Harami is one that I believe in wholeheartedly. A Harami position means that the current candlestick is fully engulfed in the previous candlestick. So Harami actually in Japanese means pregnant. So it means this is the previous candlestick and this is the new candlestick. As you can see, this entire candlestick, including it's the top of its wicks and the bottom of its wicks, are within the body of this previous candle. Okay. Now, it also, to get the full interpretation and to narrow down the signal that this is giving to you, is that the candle must be of the opposite color of the previous candle. In other words, if you have a black candle, the body from the previous candle must be white. And Harami is telling you that something is happening in the marketplace. Well, let me just get my markings off of here for a second. Okay, Harami is one of the most common candlestick patterns you come across. So it's important to recognize it, to understand what it means, to understand its limitations. A Harami is a two-session reversal pattern. It's made up of the two candlesticks and implies that the price is about to turn. It is indicated by a small body of the opposite color completely contained in the body of the previous session. It is not essential for the two candles to be opposite colors. But this tends to give a lot more reliable signal. Because I want my signals to be as finite as possible, I stick with only it must be of the opposite color. Now, I'll be blunt with you. A Harami doesn't always live up to its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reliability. And this is one of the reasons we want to use that fine decision, the fine explanation, and make sure it's opposite colors, because that will cut the false signals out of it. So let's talk about the different candlestick pattern. We talked about, so far, we talked about the single candlestick, one candle. We talked about the Marabuzu, the spinning top, doji, hammer, hanging man. Okay, we really don't have time tonight to go into all these other ones. So like I said, we had it on your handout. We had it in last week's class. We'll have it in next week's class number 1. But we have bullish engulfing, bearish engulfing, bullish tweezers, and bearish tweezers. Now, if you notice, in the candlesticks we looked at before, like the Marabuzu, the doji, the hammer, the hangman, okay, were all one candle by themselves. Now, you have to look at them where they fall in the trend, but they were one candle. Bullish engulfing and bearish engulfing, bullish tweezers and bearish tweezers are 2 candlesticks together that tell you something. So we can see in a bullish engulfing that it's almost like the opposite of a harami. In a downtrend, you need a green candle or a bullish candle to be larger than the entire session of the previous candle. And the previous candle must have been a red candle continued in a bearish candle in a downtrend. And when you get the bullish engulfing candle, you now know that that trend is over. So not only in this pattern, not only do we get what is that? A Marabuzu, we also got the bullish engulfing. So we now knew that that trend was over. Over here, we see we have an uptrend. So we have the green candle, then we get the red candle that fully engulfed the previous candle, and that tells us that uptrend is over and it's moving to a downtrend. Okay, when we go from 1 candle to 2 candles, they get a lot more reliable. Tweezers very rarely happen, but when they do, jump, react, because the rules are they're very rare. You need 2 bodies of opposite colors that appear with both the lows equidistant coming down, and they look exactly like a pair of tweezers. So when they appear in a downtrend, that's telling you that trend is over, and it must mean that the red or the bearish color came first and then it moved to a bullish color, even though that they were the same open and closes, but they both had the same lows. When you get this tweezer, it's telling you that it's over. And a bearish tweezer is just the exact opposite, upside down. That appears in an uptrend and telling you it's moving to a bearish or a downtrend. And from here we go on to 2 very important, or 4 very important candle patterns. And when they appear, they are very reliable. We have 3 white soldiers and 3 black crows. 3 white soldiers are, because back in the day where the name came up, we were using whites and blacks, or you could technically call them today 3 green soldiers. It's when you get 3 green candles with the bodies getting bigger and moving up like they're a set of larger steps. That's telling that downtrend is over and it's going to move into a very hard uptrend. If you get the 3 black crows, which you could call the 3 red crows today, you get the same in reverse. Okay. They happen very often. When they do, they are very reliable. Okay. Then we have the 3 inside up and the 3 inside down. Okay. They're a little bit complicated to explain. You need to have the handout to actually see them. But they, again, just like the 3 black crows and the 3 white soldiers, they're 3 candlestick patterns. So when they appear, again, they're very reliable. They tell you that the current trend is definitely over. But now it's time to move into some action. Okay. Now when you have gone through these various candlestick patterns, either you are ready to go to the trading battlefield with the newly acquired knowledge, or you want to shout, stop it. I'm too confused with all these funny names and shapes and can't remember these. Now, before we go on and look at some ways you want to incorporate this in your trading, I know 90% of you are sitting out there saying, damn, this is a lot of stuff. And how am I going to remember all this? And how am I going to find these all in my charts? And how much time is this going to have to spend? And how many assets can I look at like this? I know. Back in the day when we did hand charting, very few people used candlesticks because they were time consuming. And looking for these patterns and finding them and having to do multiple assets can take up a lot of time. But guess what? We're in the age of computers. And computers now can help us. So let me pop up some things on our screen. I got ready for us. And we're going to see, give me 1 second here. We're going to see just how easy we can make this for you. So where I am right now is investing.com. Investing.com has put an aid. It's free of charge. I'm not selling anything. There's a lot of them out there, but investing.com has a lot of candlestick aids. If you go and just click on the right-hand side, click on any of those pairs, and once you've opened up the chart, go under Technical, and then click on Chart Patterns. Okay, you'll see that it puts the candlesticks that are happening right on your chart. So you can see here we have both a belt hold bullish signal and we have an engulfing bullish or bullish reversal. How strong it is, where it's appearing, so you don't have to spend your time. I'm not telling you, and I wouldn't trade from these charts, but why spend your life looking for these patterns when you go in here and say, okay, this is where it happened, this is where it is. I could just now put it on my chart that I'm using, or use it on the ETX Pro chart, but you don't have to look it up anymore. You can see them all right here. They have another great tool where if you just go up to the top of the page under Technical, click under Candlestick Patterns, you can actually customize it. So you can come here and pick the time frames you're looking to do your trading in, tell you whether you want to completed or emerging patterns, whether you're in bullish or bearish patterns, what level of reliability. Okay, reliability is, like I said, 1 star is for those single candlestick patterns, 2 stars are for the 2 candlestick pattern, 3 stars are for the 3, and so that's, and then you can pick the assets you want them to watch and monitor for you, and then just click on Apply. And right now we can see right now, so I put up Ethereum, Bitcoin, and in a 30-minute time frame, so that's a 30-minute chart, so if that's what time frame you're looking for, we have 3 black crows, and if you click on the line, it's going to tell you what the explanation was, but they're also telling you that they're expecting it's 3 black crows, and they're expecting that asset to turn down. Now that pattern hasn't fully finished yet, so that means you could get this right on your chart right now and look for it. You can see completed patterns, and it tells you when they were completed. So like for instance, here we're looking at a Ripple BTC. It was a bullish engulfing pattern, and it finished 1 candle ago. So it's over with, and the markets are still feeling that repercussion. Here we can see on a 1-hour chart, we have a bullish engulfing on an ETC BTC, and that just finished. We can see so we can take a look at all of these and we can track them easily. So that's one way you can incorporate this into your trading system. So just go on investing.com. I wouldn't trade from investing.com. They're just a news site and a technical analysis site, but it makes your life easier because you don't have to sit there staring at your charts, trying to figure out where all these are. So you can then, like I said, okay, you know that you have this, if you're looking to trade Ethereum, Bitcoin, and if you're using a 30-minute chart, you can go now find this 3 black crows right on your chart and trade it from there. The other way, which is, now this chart looks crazy because I haven't cleaned it up for you, but if this is TradingView, and most charting systems out there today have some type of script. So all I went up here was under Indicators and went to the public library of scripts and found one that's a candlestick identifier, clicked on it, And look at what I got. I've got all of my candlesticks on my chart. Now, it's a little bit crazy, and the colors hurt my eyes a little bit, but I can go up here and format it. So I can decide what patterns I want to see, what colors I'd like to see them, and how I'd like them placed on my chart. And they're ready. They're all placed right on your chart for you. And so here we're looking at a crude oil chart, and we can see the most current ones that are happening right here. We can see it also is telling us the pattern. So it's telling us right now that a doji formed here. We can see a doji was up here. So we can see everything that's happening. We also see, and you can set how you want them with colors, and it gives you an easy way to incorporate this. Nobody's going to tell you what to do with it, but now you have it. So it's learning. So when you're getting freaked out about spending so much time trying to find these patterns, now if you just learn what to do when the patterns develop themselves. Okay. So we can see right now in crude oil, we just got a doji. Now we had this huge surge down, the market's recovered, and now they're not sure what to do. There's a bit of indecisiveness. Are they going to bounce back up to the high, or are they going to stay on this low? Who was in control? So that's why we got the doji. You see right now on this last 1 hour candlestick, we have no body, and we have small wicks. So what do you have? It's a doji. What's the doji tell you? There's a lot of market indecisiveness. So we were in a long-term downtrend. We had, and the only reason it surged up today was because we had a crude oil inventory, and that surged it up for a few minutes, and now it's come back down, and it looks like it's going to probably, the indecisiveness is, will it return to its downtrend? And you want to watch this to see if this downtrend will continue on. But these are ways that you can incorporate this into your trading strategy without spending or sweating the small stuff, without having to spend hours trying to figure out where these patterns emerge. Because that was one of my biggest drawbacks, that I never used candlesticks. Because even though I only trade a few assets, finding these, looking for them, identifying them, and constantly watching, because to actually miss a pattern that was appearing, So, but today, like I said, all of this is easier, to use, so we can then find easier methods to trade. And it's very easy. Then we can incorporate our candlesticks right in with our other trading patterns. So here we have a set of Fibonacci's. We're looking at stochastics down below, and we also have our support and resistance. And we were able to use our candlesticks to figure out where we want to play our stop loss. We're looking for our entry point using our candlesticks. And we also got a bearish engulfing pattern right here. And now we're expecting the asset, the euro US dollar, to come down. And we're now setting this as our take profit level, because this was the bottom of our swing lows from our previous candlesticks. So there are ways that you can incorporate this into your trading system that aren't a nightmare. So let's go back to my PowerPoint and see some ways that we can do this. So let me go back to where we were. So the first thing we want to do when we're using candlesticks is we want to look at the current trend. We want to see where price is moving. Do we have a well-developed trend? Because that way we know when we see a candlestick developing, we know what we can expect. Okay. So now, if you notice here in position 1, we had a very nice downtrend. And we got this area of retracement, or this confusion area right here. And what did we get? We got doji, doji, doji. Tell us there's a lot of indecisiveness in the marketplace. Okay. So it's a perfect confusion candle. Okay. We had two green dojis, and then we got a red doji. What the hell is going on here? But then we got a red full body candlestick here, and we return to the downtrend. Two, we got more dojis, but that was just saying indecisiveness. When we see a doji, we're trying to figure out, the buyers and sellers are just trying to figure out what they want to do. Very end. And then they made a decision and they returned to their downtrend. Now, what do we actually have here? We have a very, very tight doji, and then we got 1, 2, 3. What is that? 3 white soldiers. Well, the price moved up somewhat, but then it died out again here at 4. So you can tell a whole story of price movement with your candles. Not telling you where to enter and exit the market yet. It's kind of just telling you what is going on here. So we had the possibility of a downtrend continuation, far overweighing the possibility of a reversal. You may not like to take short positions with a stop loss order a couple pips above the high of candle 2. So when we move to 3, we would want to use 2 as our stop loss point and trade the asset going down. And here 3 would have exited. Now, the thing is, candlesticks cannot. Now, some people have these calculations of how they use the shadows, but candlesticks can't on their own. They can indicate a trend reversal, but they don't really indicate to you how far it's going to move in the reverse position. So you need to combine it with other indicators. So no candlestick chart should be used on its own. You should always combine it with other patterns or other indicators. So each candle on a chart is just a reflection of the market sentiment. Each candle on the chart may be saying something to you, but how do you listen to it? Okay, the answer that lies is in the size of the bodies and the wicks, but you need to use it with other indicators. But the first thing you have to do is master the interpretations. Now, there are many ways to trade with Japanese candlesticks. The best is in combination with other indicators, such as pivot points and support and resistance. You can trade with candles only. I give you some, all I can do is give you some guidelines and set some rules that I follow. But I can't tell you what to do. You have to spend the time and ability to get to know and understand these. So here, I've given you some patterns here. Now, when you see specific patterns, do you buy to cover? You have to fit it into your trading system. Like, I'm more of a swing trader. I'm not a day trader. So I'm looking for things that are going to happen over a while. Okay. I combine them with other indicators, but I'm more of a guy who uses different types of indicators. I'm more of a MACD type person. So I use candlesticks just to make me aware. Other people use candlesticks for the whole kit and caboodle. So the first thing you have to do is learn the classic chart and candlestick patterns to recognize them immediately on any chart. The chart patterns describe broad, predictable forces that print through all time frames and offer outstanding trades. Candlestick patterns, along with chart patterns, predict outcomes as they reveal the will of the crowd. They point to time and direction because herd behavior drives a common will at key market intersections. But perfect patterns rarely appear in the modern market environment. Learn to execute comfortably in the debris-filled landscape. Understanding how to correctly interpret and utilize candlestick patterns will help you navigate your decision making through murky waters. Pattern recognition doesn't work for everyone. Some folks will find far greater success building trading systems or studying balance sheets. Avoid mixing systems and discretionary trading into one strategy because they don't mix. A good pattern never signals when to trade or when to set aside. It points to a convergence of time and direction that should trigger predictable movement under the right circumstance. It's the trader's responsibility to formulate tactics that capitalize on the setup if it unfolds and protect the trading account if it fails. In other words, always use risk management. There is no single method to trade any pattern, and no setups will evolve the same way twice. And even though you'll read all types of people out there tell you, do this, do that, do this if that happens, they're just trying to convince you to do it their way. You have to convince yourself to do it your way. So a candlestick pattern tells you something about market sentiment. The candlestick does, the pattern does. It should be part of your interpretation, but it should not be part of your entire trading decision. And like I said, there are all types of systems out there. Systems that somebody's preaching, if you use the swing low of the 19th candle back and set that as your stop loss and use the swing high of the fourth candle to the right to set your target point, that's what they're preaching. I always say, combine trend lines, volume, support and resistance, and other indicators, and use the candlestick patterns as your trigger. It should be telling you, okay, we have something emerging in that price, because candlestick patterns are directly on your charts, and they are directly related to price action. So you're saying, okay, price action is telling me something. Let me then combine it with my other tools, and especially my risk management, my profit loss ratio, and decide whether it is alerting me for a good trade, a bad trade. Maybe there's not enough pips in it. Maybe it's just, okay, this trend is over, but not enough to say a new trend is starting. So remember, there is no single way. Always keep one eye on the clock. Time eventually turns against the pattern if price just sits there. Technical indicators start rolling over and the patterns can morph into unpredictable massless bars. Choose entry levels wisely and exit immediately if the pattern deteriorates. Following proven and time-tested Japanese candlestick principles will always steer you into making good decisions. It is not immediately apparent that price is trending upward, evidenced by bullish signals here. You should always be looking at the importance is of always be looking at price action and trends. Okay, don't be trying to force these. But like I said, there's all types of people pushing different strategies out there. Okay, combining candlesticks with other things. Moving averages works extremely well with candlesticks, and if you want to trade a crossover with moving average and candlesticks. But together they might help you build a better system. Okay. Entry points will be based on the close of the confirming candle of the trend. Remember to only enter a trade after you spotted a changing trend in which it has been confirmed by another candle after the reversal pattern, or with another indicator as a second confirmation. Traders following candlestick charting are at a distinct advantage here. They realize that the stop loss point is a function of a candlestick buy or sell signal itself. So you can use your candlesticks to place your stop losses, but proper stop loss techniques identify the price levels which negates the signal. So in other words, you're not looking at what price, but what you're looking at the price, but not in a risk management risk reward ratio. You're looking at saying, okay, this is where I would have to place my stop loss, because at this point that candle signal will be negated. Then you have to go back and figure out if it fits your risk reward ratio, and you can make it. Now, there are all different types, like I said, of systems out there. You can go read about on the internet. They're all available out there, but you have to first learn them yourself. There are many, many more patterns that you can learn to recognize. However, the patterns I've chosen to include are the ones that I find most useful. And like I said, if you come back to next week's first week's class, I'll give you the handouts again. Candlesticks can be a very powerful trading tool, but they are not best used in isolation. Combining them with simple pieces of technical analysis, and they will give you a clear signal that the market is right for you to open your trade or close out your position. Use them alone and you may find out you are too close to the price picture to see what's really going on. When used in conjunction with a successful trading strategy, I hope you will find that candlestick analysis will enhance the system and improve its performance. And as you become more and more familiar with candles, you will learn to instinctively read the story that each one is telling you. So on that note, I'll say goodnight to everybody, wish you all the best, and I'll see you in Sunday's class. And again, we'll be repeating the class 1, I believe, next week. Just look on the ETX education schedule. So thank you very much, and we have 12 all-new classes coming in January and February and March. So we've got a whole bunch of new stuff coming for you. So look forward, and they'll be posted probably in the next 2 weeks for January and February. So we'll talk to you all again real soon. Have a good week, and enjoy the beginnings of the holiday season. Bye now.